And we have the famed economist, the former IMF chief economist, now Harvard professor, Ken Rogoff, joining us live from Boston this morning. And boy, oh boy, Ken, take a look at the bloodbath on the markets. Lots of fear, lots of jitters. But is it deserved at this point?
Well, I think some of it, yes, that there's a recognition that this isn't ending anytime soon. We're going to have slow growth for a long time. There's no question there's an element of panic here, particularly concerned that policymakers are not with reality. They don't quite know what's going on in Europe. They don't seem to have a plan. We saw the debt deficit debacle in the United States. And central banks have been tightening policy recently when clearly they need to be going the other way now. So I think there's a sense of panic. Hopefully central banks first and maybe other policies later will step in and stabilize things. But right now it's scary.
It is scary, especially when you have 7% declines across the board on Wall Street. Ken, what about this S&P downgrade? Because that seemed to be, say, the straw that broke the camel's back this week. Was it deserved?
Camel's back wasn't looking too good last week. I mean, I'm not so sure that was it. It certainly shakes up markets. There's a lot of emotion and fear. Absolutely, it was deserved. I mean, I think S&P called a spade a spade. Look, you know, AA plus is still a very high rating. It's not about to say there's going to be a default. But, you know, I think this debt debate really challenged the institutions, the way the United States does business. It wasn't just about reaching a deal this time. It's next time and 2 years from now. So certainly it was a concern, and they didn't solve any problems, really. They didn't solve any of the hard problems. So I think S&P made the right call. It was very courageous. The other agencies are going to follow in due time, whatever they're saying now.
Well, it was courageous, but is this the right time to be doing that? You know, we saw Warren Buffett saying he didn't understand the thought process. The U.S. is quadruple A in his views. But let's talk about what this means for the economy. Are we in for a double dip, considering we're already at stall speed?
Well, frankly, I think all this talk of double dip is really beside the point. We're still in the last contraction. This is not an ordinary recession. This is a post-financial crisis recession, as Carmen Reinhart and I have emphasized. We call it a great contraction, not a recession. And this volatility, this slow growth is just part of it. It's just, I think unemployment's still high. Housing prices are still low. Credit is still very tight. I think that, you know, whether we have a technical recession or not, it's certainly a difficult situation. And I think out-of-the-box policies are called for. I'd say especially much more aggressive monetary policy, however unpopular that may be.
Let's talk about China and, I guess, a new world order, because some of them are saying that the U.S., mired in recession still, is basically a thing of the past, and the engine of the future is China.
Well, there's no question the engine of the long-term future is China, but it's not big enough yet to be an engine of growth to pull up Europe and the United States with it. So China certainly is a linchpin for the emerging markets, though, right now. If something were to happen of a slowdown in China, they really wouldn't be left with a leg to stand on. This wouldn't be a good time for that to happen. Let's hope it doesn't.
Yeah, Ken, last year we were talking about China and how you were talking about the property sector possibly impacting the banks, and we could see, you know, a crash on the mainland. Is that still your theory?
I think it's very difficult to grow at the pace China does. Debt has really been rising very sharply. If you look at measures of domestic credit, 150% or more of GDP. It's very hard to grow at that pace and never have a financial setback, never have a recession. And in some ways, it's the ultimate this time is different story. It will. But of course, that doesn't mean it's not going to do well. Every country has these financial crises and emerges from them. I hope that the United States and Europe emerge from theirs, but that looks a ways off.
Yeah, I guess for the time being, I'm trying to ask if China and its growth is enough to make up for what we're seeing in the U.S. and Europe right now.
Well, if it were, we wouldn't be seeing global markets crash like this at the sign that the U.S. and Europe might be going into recession, might be slowing. I think it's very helpful that China is growing so well, but it's only a piece of the whole picture.
Okay, well, let's talk about what's happening in the U.S. again. You know, a global market sell-off that looks unprecedented. Seems like 2008 all over again, doesn't it, Ken? But it seems that investors are screaming right now at the Federal Reserve to do something, help us out, give us some more stimulus. Do you think that's going to happen?
I think it is. I mean, I think the thinking had been that Ben Bernanke would wait until the Jackson Hole and give a speech, but, you know, the things are moving very, very fast. On the other hand, he has to bring his committee along with him. It's hard to know, but they certainly should do something right away. They shouldn't have stopped the QE policy, as controversial as it was. They should have extended it, and maybe they need to bring in inflation targeting. I think that when they bring QE back, and I think they will, it ought to be together with very clear statements that they're trying to create inflation, moderate inflation, and they should back off of saying they're trying to raise the stock market. That was a bad idea.
Yeah, you know, Ken, some are betting that's the most the Federal Reserve will do is just keep its balance sheet where it is, expanded by, I think, about $2 trillion. Is that enough?
No. I think it's going to move more decisively. I think it should have. It didn't handle the first round right, both in the communication strategy. I mean, in the classic classroom QE, it's open-ended. You say, I'm trying to create inflation of, let's say, 2 or 3%, and I'm going to do whatever it takes. You don't say, well, I'm going to do 200 billion, 600 billion until it stops. It's very hard to calibrate it. They need to move much more decisively. Frankly, Europe could use the same. The tightening monetary conditions in Europe were not helpful, and Europe needs much, much looser monetary policy as well.
That's right. So they raised rates ahead of the curve. And, Ken, people are talking about policy mistake in Europe as well. It took you this long for the ECB to buy Spanish and Italian bonds. What's going to happen in Europe?
Well, they're nowhere near an end game, and the ECB is buying Italian and Spanish bonds, but I don't think they're buying very much at the moment. They need to really come in overwhelming force. But then, of course, they don't want to get stuck with the bonds at the end. They want the governments to say they'll back them. It's a sort of a stare down. I think the ECB will lose. They'll end up having to buy a lot of these bonds. And eventually the Germans will find that they have to back Italy and Spain much more forcefully than their population would like. But they don't have a lot of good moves right now. That's part of why everyone is so nervous.
Ken, one more question for you. Give me a forecast for, say, the remainder of this year, maybe 12 months out, because, you know, you see the markets, heavy losses. People are losing their pensions right now. But given the headwinds in Europe, in the U.S., what kind of global economy will it be for the next while or so?
I mean, I think the best guess is sort of moderate to slow growth, not necessarily a collapse. That is the norm. But again, we're at a very scary, critical moment where the policymakers really do need to step in to stabilize everything. There is a deficit of credibility here. That's really what's missing. The policymakers have been behind the curve again and again. They've been saying it's over, it's not. And they need to step in and have credible policies, recognize it's slow growth. They need to deal with the problem, not keep kicking the can down the road.
All right, Ken, thanks so much for sharing your insights today. It's always a pleasure to have you. Ken Rogoff, Harvard University professor, joining us from Boston, Massachusetts.